right. Welcome back to the Know Your Numbers REI podcast. I am your host, Chris McCormack, CPA, MBA, and certified tax planner, here with Better Books, where my wife and I are committed to growing your confidence in the real estate area of the tax code. We know that many of you struggle and are concerned or overwhelmed, maybe a little confused with how much there is to know about taxes when it comes to your real estate portfolio. And so it's our job to come alongside you and really be your advocate, give you the confidence and the assurance that you need to know that your real estate portfolio is operating to the best of its ability, right? We often talk about the 4 reasons people get into real estate. 1 is cash flow, 2 is appreciation, 3 is leverage, and 4 is tax benefits. And if your portfolio is missing out on any one of those 4 things, then you are missing out on dollars in your pocket, dollars in your investor's pocket, dollars in your family's pocket. And so it's our job to really come alongside you, as I mentioned, and help you out, figure out that 4th pillar. We really focus on the tax benefit side because we know that a lot of you can get the cash flow. You know how to crunch your numbers, or maybe you don't, and we can help you there. But you can do cash flow. You obviously, once you acquire the property, it's appreciating on its own. And then it's also a vehicle for leverage. But really where we see a lot of people coming up short is the tax benefit side. And so that's what our goal here at Better Books is. And today we're going to be diving into a topic that is very near and dear to my heart. It's very important for all of you to know and understand. But before we get to that, I'd just like to preface by saying if you get any sort of value out of this, please do us a favor and leave us a 5-star rating and review. And if somebody you know might get similar value out of it, then go ahead and share it with them, because the more people that know about these insights, the more people that know about what we're doing, the more that we can together grow our own economies, which also aids in the growth of the nation's economy. So with all that being said, let's jump into it. Today, we're going to be talking about real estate professional. You know, we get so many questions and concerns about the topic of real estate professional, whether you qualify, what you need to do to make sure that you qualify, who you should be talking with to see if, even if you qualify, you're getting that benefit. Because we also know that just because you qualify doesn't mean that your accountant knows you qualify, or doesn't mean that you are preparing your taxes according to that qualification. So today we're going to be diving into real estate professional, what it is, some of the things that you should be aware of. And ultimately, our goal is always to have you get a sense of knowledge, but also meet with somebody who can give you more confidence, because everybody's situation is unique. You have a different situation than I do. And so that's what we are. We are your tax pilot. If you come to us, we can tell you some of the things that you're missing out on, some of the mistakes that you've made, and ultimately give you the confidence to know that you have what you need to get to your ultimate destination, which is your financial goals, your tax goals, your wealth building goals. So today, let's get into it. Real estate professional. What is it? Why is it important? And it helps to start by talking about, what is it and why it is even a thing. So in, I believe it was the 1980s, the Congress and Internal Revenue Service, IRS, came out with this big tax overhaul. And a part of that tax overhaul was this code section, the Internal Revenue Code section 469. And in it, it says that all real estate activities are passive activity. A passive activity constitutes any real estate or any trade or business which the taxpayer does not materially participate. So you see in that they distinctly, specifically call out real estate. And that's because if you know anything about real estate and you know of the tax benefits, you know that oftentimes you can generate a loss on paper, even though you might be making money through your portfolio. So what people were doing, high income earners specifically, like doctors and lawyers and accountants, they were investing a bunch in real estate, generating losses through the power of depreciation and some of the other deductions that we talk about. And then they were able to write off substantial amounts of their active income, the money that they were making in their doctor practice, in their law practice, in their accounting practice, whatever the practice might be, they were able to offset that with the real estate income, even though it was taking up a lot more time. So Congress comes out 1980s and says, we can't do this. We're losing out on a lot of money, because these high income earners are also a big dollar sign for us. Traditionally is they're making a lot of money, but they also pay a lot of money. And so in order to make sure that we're getting our fair share of that money, we're going to say that all real estate is now a passive activity unless you materially participate. And that's what real estate professional is, this idea that you are being able to fit into this bucket that talks about material participation. And what constitutes a material participation in any activity, there are really two things to keep in mind. One is what constitutes an activity, right? So the first part of that passive activity versus active activity definition is any trade or business activity which the taxpayer does not materially participate. So we're going to look to define the activity, and then we're also going to define what is material participation. So the first thing that you should think about is what constitutes an activity. And I can't tell you how many times we meet with people like mortgage brokers, for example, or even myself as a tax accountant focusing primarily on real estate investors, real estate clients. What is stopping me from claiming material participation? Because the majority of my time is focused on real estate. And so to stop that, similar, again, if accountants and lawyers are able to qualify for full deduction of the losses they get from real estate, then the US government loses out because they're not getting their tax dollars from those high earners. So an accountant cannot qualify for real estate professional status, assuming he's trying to claim it as his practice is that serves real estate investors. And that's because, again, the Internal Revenue Code distinctly calls out an activity as being real property development, redevelopment, construction, reconstruction, acquisition, rental, operation, management, leasing, or brokerage, trade, or business. So if it's not in any of those categories, it's thrown out and you don't qualify as real estate professional. So what are some of those activities? One is the development, redevelopment, construction, reconstruction. So people that are building these big apartment complexes, you can potentially qualify, assuming, again, you meet that second checkbox, which is that you materially participate. So once we get activity through our heads, once we know that we qualify under the activity. So again, that eliminates people like myself. That eliminates your mortgage brokers, right? We meet with a lot of mortgage brokers who, yes, their main area of business is technically real estate, right? They're writing loans out for people to acquire properties, but because they are not called out specifically in this definition, they are now disqualified from being a real estate professional in their mortgage lending. So what constitutes material participation? Once you know that you do fit that area of activity, how can you know that you qualify for real estate professional under the guidelines of the Internal Revenue Code? Because there's one thing to say that you qualify for real estate professional. It's a whole nother thing to actually qualify. And this is so important because, again, we meet with a lot of investors who believe that they qualify for real estate professional, but then unfortunately they're caught off guard because no, they don't actually qualify because they didn't fill in some of these important forms that you need to fill in to ensure that you can qualify given your specific situations. Again, it's specific to your unique circumstances, and this is why it's so important to work with a tax planner who is focused on the real estate industry, right? Because you can go to a CPA at year end, you can tell him that you qualify for real estate professional status. If he's not up to speed on all of the regulations, or if he's just trying to get you in and out as quick as possible, he might not do his due diligence, and then you're at risk of losing an audit, because material participation in real estate professional status is one of, if not the most audited areas when it comes to personal tax filing. So this is not something to mess around with. Again, if you even have a question about whether you qualify, or maybe you think you qualify, or maybe you don't think you qualify, but the option is still on the table, meet with a real estate tax planner to ensure, to have that assurance, that confidence that you are doing everything in your power, legally and ethically, to pay as little as possible in taxes while also avoiding the costliness of an audit. So what do you need to know about material participation? There's 6 tests for a real estate professional. You have to qualify at least one of those 6 tests in order to meet this material participation. The first one is more than 500 hours in the year in participation of the activity. So this is the biggest one, right? You want to qualify for real estate professional. You need to make sure that you meet the hour requirement, 500 hours. And oftentimes I recommend more than 500 hours because, like I said, real estate professional is highly audited. And one of the things they'll do when they come in to audit you is make sure that you, one, have records showing the amount of time. But if there's anything that doesn't qualify under the development, redevelopment, construction, reconstruction, acquisition, rental, operation, management, leasing, or brokerage, trade, or business, they'll throw it out and that will deduct the number of hours. And all they need to do is prove that you didn't have 500 hours. If you had 499 hours, you do not qualify. Number 2, participates at least 100 hours during the year and more than any other participant. Now, this is a key because there's a lot of people that traditionally don't qualify as real estate professional because they don't meet those 500 hours, but their time does meet 100 hours and it's more than any other participant. So that could be you. It could be that you qualify under this guideline number 2, but it could also be that this disqualifies you because you're not participating more than any other participant, right? You could have a property manager who is at your properties more than you are, who's doing more work than you are throughout the year. And if you are not the number 1 participant in your real estate activity, even if you have 100 hours, you don't qualify under number 2. Participation in the activity constitutes substantially all of the activity. Why I don't suggest doing taxes on your own, especially not doing tax planning, because participation in the activity constitutes substantially all of the activity. What the heck does that mean? It could very well be that your activity, your participation constitutes substantially all of the activity in your mind, but the IRS has the ultimate say in whether it's substantially all of the activity in their mind. And what they will do oftentimes is look to the number of hours or the number of participants, right? So if you have property managers, chances are you don't qualify under this third one. But again, remember that you just have to meet at least one of the following 6 tests. The next 2 are a little bit questionable. Most times we look to have people qualify under those first 3. The next one is individual materially participated in any of the 5 of 10 preceding years. And they're saying, okay, if you materially participated in 5 of the last 10 years, like you might not have 500 hours this year, but the last 5 years you did, or the last 5 out of the last 7 years you did. And then they're like, okay, you're a real estate professional. But again, it still comes down to whether you qualified in the years prior. And this is why working with a tax accountant on an ongoing long-term basis is so important. So you know, and your accountant knows your unique situation for the long haul, right? We are all about relationships here at Better Books. And that the main reason is because in order to fully understand your goals, your challenges, and where you've been, where you want to go, we need to have a personal relationship with you. And we're not the type of accountant that will take your information in March, prepare it, give it back to you in April, and then not talk to you for another 12 months, right? If you're a tax planning client, you get us on a regular basis. You're building relationships with us. We're understanding your goals, your dreams, your challenges, and where you want to go with this thing so that we can plan ahead and so that we know how often you participated in real estate in the previous years. Number 5, individual participates in the activity for any of the 3 preceding years, and it's a personal service activity. So this is not something that we really focus on because of the way personal service activity, there's certain qualifications you need for that. I don't have it all off the top of my head, but understand that the reason this is one of them is because material participation doesn't just go for real estate. It also goes for other activities. There could be some activities that I operate in that I'm not an active participant in, but I get an income or I get a loss. And in order for that to offset my ordinary income, which is the goal here, is when you're qualifying for real estate professional, you offset your ordinary income with a real estate loss. That it's not the only industry that you can do that in. I can have other businesses that I operate a loss in, but it might not offset active income because it doesn't meet this material participation. And this 5th one here is really why we're looking at that and why that's even in the Internal Revenue Code. And number 6, the individual participates in the activity on a regular, continuous, and substantial basis. Basically, that summarizes the first 5, right? Is regular, continuous, substantial basis. They're going to look at some of these other guidelines that they have for what it means to be an active participant in order to determine whether you participate in the activity regularly, continuously, substantially. So it's really important for you to know about this stuff. It's also really important for you to have a professional in your corner who knows about this stuff. My challenge to you is to have confidence, right? And you get confidence by knowing these things, but you also get confidence by knowing that somebody else who has the licensure and the qualifications to back you up as well, because this can make or break your tax profile, right? If you don't qualify, or maybe you do qualify and you don't know about it, you're missing out on hard-earned money that is better in your account than it is in the US government's. And if you're doing it the wrong way, there's a slim chance of winning if you don't have the right record keeping and the right team in place. And so again, meet with a tax planner, meet with a tax professional who is specific to your industry, in this case, real estate, and knows your goals, right? Knows your profile, knows who you are, knows who your family is, knows what you want to do with this life, and is willing to work with you and advocate on your behalf to make sure that you're able to do that and you're not paying a boatload in taxes and it's chipping away at the likelihood of you achieving those goals. So I would encourage you to meet with a real estate tax professional to make sure that you qualify. But I do believe that it's important for you to know about these things as well, which is why we're offering this to you completely free. If you did get any sort of value out of this, please do us a favor, share it with a friend, and follow along for more insights as we continue to dive into the confusing and overwhelming concept of real estate taxes. God bless you all. We will talk to you again soon.